We have to make a usable product. So if the chair is mathematically very sophisticated and complicated, but you sit on it and if it breaks and you fall down, well, it doesn't matter how beautiful and elegant the actual design was, it didn't actually achieve the goal it was supposed to achieve.
Welcome to FTSE Russell Convenes. I'm David Sol, and in this session we'll dive into portfolio construction approaches in an era of systematic strategies. I'm here with Dr. Joseph Simonian, Head of Equity Portfolio Design and Analytics at Calpers and the author of many academic papers, such in the Journal of Portfolio Management. And I'm with Sebastian Lancetti, Head of Equity Index Design at FTSE Russell. Now, before we dig into the details of portfolio construction, let's take a step back. Portfolio construction, I'm thinking about optimization, lots of maths, very complicated. Why are we doing this? Why are we making this so complicated?
Well, it doesn't have to be complicated, but I think the reason we do it is because we have to have a formalized process typically in order to defend the ultimate allocation of weights in our portfolios, which is what portfolio construction is. Ultimately, it's the allocation of weights. It can be separated from security selection. It can be combined with it, but it can be separated from it as well. The reason we use somewhat formal or mathematically rigorous methods is because we benefit from the clarity and the objectivity that an optimization approach, for example, brings to the process. If we didn't use some kind of a formalized process, we would essentially be artistically deciding the weights in our portfolios, and that's not defensible from a stakeholder standpoint or from an investment theory standpoint, if you will.
So we're doing it to get some kind of framework, some kind of structure. And now I'm always thinking, portfolio construction, is this art or is this science? I know, Sebastian, you do a lot of back testing. Is it art? Is it science? What's your view?
It's definitely some science with a lot of art. I think adding to what was just said, very important from an index provider standpoint also to consider the fact that everything we do needs to be systematic, needs to be put in rules, and portfolio construction techniques can be formulated in a way that are replicable and so that our clients and the marketplace knows exactly what is happening in our indices too.
So let's dig into some portfolio construction techniques. Well, give me some examples. You want to kick off first, maybe with some?
Sure, I'll list some of the basic ones. Of course, many of our viewers know mean variance optimization, modern portfolio theory, Markowitz's approach. And this essentially involves considering expected returns, volatilities or variances of assets, and covariances or correlations. But then you have other techniques. You have frameworks that incorporate multiple objectives. You have approaches that are specifically attuned to liability-driven investing. You have some approaches like Black Litterman, which allow the investor to inject their subjective views into the process. So there's been decades of research, of course, that is continuing today in this area. A lot of it is very mathematical, but I think from my standpoint, the important thing is to take the practical applications of any framework if they're suited to your particular use. If they're not, then it just becomes a theoretical construct on paper. So there's a list a mile long of techniques that we can talk about for hours. Those are some of the major ones, but there are very highly tailored approaches that are coming out all the time that speak to one specific aspect of investing. So there's a whole inventory.
So Joseph, so what you're saying is you have an investment process from kind of asset allocation to estimated returns to the way you implement your trades. And for those different parts of the investment process, you'll use a particular technique from portfolio construction. Is that how I should see it, as a kind of a menu that you pick from?
There can be. Each part of your investment process may very well incorporate different optimization techniques, but they don't have to, right? I think what I was referring to is that at the beginning of your investment process, you ask yourself, okay, what are we doing here? What are the most important inputs? Are there correlations that are very important? Or is it more the liability asset relationship that is most important? Of course, these things aren't always easily separate from each other. Often the same considerations apply to different contexts. An LDI or liability-driven investor is going to think about correlations as well as an asset-only investor. So I don't want to make it as if every optimization framework is so specific. However, there are fine tunings that you have to do along the way to essentially apply any given framework fruitfully to the application that you're looking for.
And you've written many different papers on portfolio construction. How do you see the evolution? I mean, you were writing about things 20 years ago, 10 years ago. So what are the type of things you're writing about now in your journals?
On the optimization side, I think what many of us had written about fairly recently are ways of allocating amongst factors versus assets. Factors, which we know, they inject a little bit more flexibility in how you can do the allocation of assets. And so understanding, what are the differences between an asset class-based optimization or portfolio construction process versus a factor-based one is important. Now, again, it's not necessarily a hard dividing line, right? You can look at the world through the lens of assets, asset classes, but also factors. But I think, a factor approach does open up some more vistas, if you will, or possibilities to allocate in unique and interesting ways. Again, I've also written about the liability-driven investing side quite a bit in terms of trying to develop portfolio construction frameworks that speak to the LDI or liability-driven aspect of investing. And that's obviously important in various kinds of pension and insurance applications. And then I have also written quite, a lot on the Black-Litterman model, extensions to it. I've presented quite a few extensions to it. And again, the Black-Litterman model is derived initially from the mean variance framework that many folks are familiar with, but it overlays the ability to inject the subjective views of the portfolio manager, which allows it to incorporate more real-time information, which obviously benefits us because we have seen events like COVID and other things where you can't rely on a historical data set. So it may behoove you to actually utilize more real-time subjective inputs. And there have been models like that are coming out all the time, again, for very specific applications, right? It's like the gift that keeps on giving. You can never get enough optimization. And then, of course, on more the academic side, there are very highly mathematical papers that come out. And our papers are mathematical as well, but they are first and foremost intended for practitioners to be used. I think a lot of the academic papers, a practitioner has to really sort of peruse these papers pretty in depth and tease out the useful aspects of them because they have a lot of, I'll call it accoutrement, right? Additional elements to them that may not always be applicable. So I think that's the one caveat I would give in looking at optimization techniques from the academic world is that there's going to be a lot there. Not all of it is applicable to practical portfolio construction.
And Sebastian, you work a lot with clients, asset managers, asset owners on building indices, constructing them. How do you approach portfolio construction? What type of discussions do you have? And what's your philosophy about building in robustness in strategies?
Yeah, we have a wide range of approaches to build the exposures and the portfolios that our clients are looking for. On top of everything, going back to the point, academic versus practitioner, also a very important aspect is just a lot of our clients have constraints. They have maybe exclusion list, they might have all other targets are not purely return-based targets. And so we need to incorporate that in the portfolio construction process and do so efficiently. So we want to make sure that the index we produce ultimately reflects the intention of a client, but also is somehow optimal in terms of enforcing the constraints of the client-specific request. So that's another dimension to it. One thing is the performance, the alpha, the behavior, the risk behavior of a portfolio, but also the enforcing the constraints as well.
Now, what's interesting, you have the theoretical performance through the modeling. You, on the other hand, Joseph, you deal with indeed the practical implementation of really big portfolios. We're talking about thousands of securities. Can you go a bit into the detail? What type of things do you have to think about when you deal with a big scale in terms of implementation versus the theoretical approach that we can do on the kind of the index design?
Yes, well, I think whenever you're dealing with an optimization framework, first and foremost, you have to understand that at the base, it's a mathematical construct. And it may very well be the case that the individual who has built this framework did not have experience or practical portfolio management implementation in mind. That's not to say anything negative about their background or their intentions. It's just that often a framework is presented saying, look, if we actually change the math in this way or that way, we get better outcomes using a specific set of historical data. When you have a larger scale portfolios, what happens often is that the implementation issues often present challenges to you that you have to confront, and you may have to either change or relax or loosen or somehow modify a chosen framework, right? Because as mathematical constructs, what will happen is that these optimizers or optimization frameworks, what they'll want to do is allocate in a specific way that is more or less rigidly loyal to its framework. But then when the output comes, you may say to yourself, wait a minute, I understand why it's doing that mathematically, but from a practical standpoint, I can't have this kind of allocation or this concentration or what have you. And so you'll have to think about that. And you don't want to just artistically, smudge the numbers. You can't do that, obviously. So what you have to do is you have to, in a formal, rigorous way, modify the framework or come up with a new framework that actually is much more practically attuned to what you're doing.
So you have your framework, you then use some kind of overlay, common sense almost, I would describe it, to see whether or not you go to extremes in your output. Is that how I should view it? Or?
I'll give you a more specific analogy. I think in finance, we often think of ourselves as, especially quants, as scientists. I think that's incorrect. I think we are more similar to engineers or maybe even cabinet makers. We're craftsmen. We have to make a usable product. So if the chair is mathematically very sophisticated and complicated, but you sit on it and if it breaks and you fall down, well, it doesn't matter how beautiful and elegant the actual design was, it didn't actually achieve the goal it was supposed to achieve. Wouldn't they say we're building chairs? I know it's not as glamorous as thinking of ourselves as a scientist in a laboratory. And yes, the chairs may be complicated, right? They may be sophisticated chairs, but ultimately we're a craftsman. And so we have to think about the end product in mind, which is a portfolio that speaks to stakeholders and anybody else who has a vested interest in the good performance of our portfolio. That goes for any kind of real investor, whether they're a large institution or a small wealth manager. You have to think about the end product. It has to be a practically usable thing. And if you have to deviate, again, in a rigorous and formal way from an established framework or a framework that you liked on the merits on paper, then you have to do that. It's just how it goes, because you have to deliver something that works ultimately.
I like your analogy of the cabinet maker. Sebastian, I know last year we spoke a lot about concentration issues. It was a big theme in the building of portfolio construct. How is concentration now at the forefront of investors? How are you thinking about it?
Yes, I think if anything, things got a little bit worse compared to last year. So we have still very, very concentrated markets, specifically in the US, if we think about the growth segment. And that's a perfect example where you can do a lot with even simple portfolio construction techniques. Doesn't need to be an optimizer all the time, but just to make sure that ultimately we build also indices that are more diversified and also less prone maybe to what happens to individual names. So that's still very, very much a big topic in indexing. So we actually about to launch a new methodology to do that. And in general, again, going back to what was just said, also very important when we think about optimization, portfolio construction, are the stakeholders. And especially from an index standpoint, we are very public in what we do, and we must make sure that what we do is also understandable to all the stakeholders. So one thing is how elegant or mathematically sound a solution is, but it also needs to be tractable, transparent, and understandable to a broader audience as well.
So it's very much about dialogue with the end users, trying to understand what they want to achieve, and of course discuss the assumptions with them in depth so that they know what they are holding. This has been a fascinating discussion. There's more to portfolio construction, and we'll be keeping an eye on your papers and of course the indices that you're building out of FTSE Russell. Thank you very much for this interview.
Thank you.